Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we are drilling down deep on Carnival Corporation, that's ticker CCL. Now, they just dropped their Q1 2026 earnings, and look, on paper, it's an absolute masterpiece. We're talking record revenues, record bookings, a solid beat on earnings. I mean, by all accounts, management should be taking a victory lap right now. But here's the thing, here's the contradiction, and it's the entire reason we're doing this explainer. While Carnival was popping the champagne, Wall Street was mashing the sell button, driving that stock down almost 5%. You know, that's not just a little wobble, that's a serious warning shot. It's a signal that there's a story here the press release isn't telling you. So what exactly is Wall Street seeing that the average investor might be missing? Well, that is our mission today, to put Carnival to the forge and see if it's solid iron or just the polished fake.
Right, and the disconnect here is just, it's jarring. I mean, look at this. The left column is a CEO's absolute dream come true. Record revenue, record bookings, EPS beat. These are the magic words, the keywords that are supposed to trigger all the buy algorithms and send a stock to the moon. But then your eyes drift over to the right column, to the cold, hard reality of what the market actually did. A punishing 4.6% drop on a day the S&P 500 was basically flat. This just doesn't compute, right? How does a company report its best quarter in its entire history and watch its shareholders get absolutely wiped out? Is the market just being totally irrational, or is there a deep structural crack in this company's foundation that these shiny headlines are just papering over? This is the mystery we are here to solve.
Okay, let's lay out the game plan. First, we're going to dissect that bizarre disconnect between all the good news and the market's immediate sell-off. Then, I'll take the lead. I'll be your analyst here, and I'm going to forge the bull case for Carnival, piece by solid piece, using their own data. After that, our resident market skeptic is going to step in and pressure test that case, looking for any of those hidden cracks. From there, we'll examine their big PROPEL growth plan, tackle the absolute mountain of debt that is weighing on their balance sheet, and finally, we'll deliver our verdict. Is Carnival a golden opportunity, or is it a very dangerous trap?
All right, Section 1, Headline versus the Market. Let's really dig into why Wall Street looked at what was basically a royal flush of good news and decided to fold its hand.
So you've really got to understand that the company's messaging was completely, totally unambiguous. You're looking right at the headline from their own press release, achieves record first quarter operating results and record bookings. I mean, there is zero hedging in that language. Management is telling the world in no uncertain terms that they've just hit a grand slam. They are shouting from the rooftops about their operational strength, their pricing power, their customer demand. And look, this isn't just some corporate spin, it's a declaration of victory. And that's what makes the market's brutal contradiction so fascinating.
And here is that contradiction in stark visual terms. While management was busy patting itself on the back, traders were sprinting for the exits. A 4.6% drop, that is a statement. That's the market looking at those record results and yelling, "We don't believe you." Especially when you put it next to the broader market, the S&P 500, which, it barely even moved that day. This tells us that the big money, the institutional investors, they aren't just looking at the last 3 months. No, they're looking way ahead, and they see a very specific risk on the horizon that, in their view, completely outweighs all of this positive operational data.
Okay, Section 2, Forging the Bull Case. Now it's my turn to build the operational fortress and show you exactly why. Based on the hard numbers, Wall Street might be getting this dead wrong. We're going to ignore the market noise for a minute and just focus on the fundamentals.
So, the foundation of any good bull case is the top line. And let me tell you, Carnival's is made of solid iron. $6.2 billion in revenue for the first quarter alone. Now, this isn't just good, it's a record. It completely blew past analyst estimates, and it represents some serious growth from the $5.8 billion they posted just a year ago. This isn't some financial engineering trick. This is raw, unadulterated demand. It tells us that consumers are flocking to their ships, they're paying higher prices for tickets, and they're spending more money on board. You simply cannot argue with this number. It is the bedrock of operational health.
Now, what's truly impressive here is how that record revenue is translating directly to the bottom line. See, it's one thing to sell more stuff. It's a completely different thing to become more profitable while you're doing it. In Q1 of last year, Carnival actually booked a net loss of $78 million. Now fast forward just 1 year and they've swung all the way to a net profit of $258 million. That is a massive $336 million positive turnaround in just 12 months. This proves they have tremendous operating leverage. As that revenue grows, their costs are being controlled and the profits are just exploding. The engine of this company has roared back to life.
And the transformation is it's stark. I mean, look at this. From being firmly in the red just a year ago to a strong profit this quarter, it's a complete night and day difference. This isn't some small incremental improvement we're talking about. This is a quantum leap in profitability. This is the kind of chart that screams successful operational turnaround. It's tangible, hard proof that all the heavy lifting management has been doing, optimizing routes, managing onboard costs, refining their pricing, it's delivering powerful results directly to the bottom line.
Okay, and let's drill down to what this really means for shareholders. Adjusted earnings per share came in at 20 cents. First off, that beats Wall Street's consensus estimate of 18 cents, which is always the mark of a well-managed company that knows how to underpromise and overdeliver. But the real story, the headline here, is the growth. That 20 cents is up 50% from the same quarter last year. A 50% year-over-year growth in earnings. That is the kind of metric that growth-focused investors absolutely hunt for. It demonstrates powerful margin expansion and just superb execution.
And get this strength isn't just some backward-looking snapshot of the last 3 months. The forward indicators are arguably even stronger. Customer deposits, that's money customers have already paid for future cruises, are at an all-time high of nearly $8 billion. Think about that. That's a massive war chest of future guaranteed revenue. On top of that, bookings for the rest of 2026 are already trending up by double-digit percentages, and crucially, they're happening at historically high prices. This shows the momentum isn't just continuing, it's actually accelerating. Operationally, this company looks unstoppable. So there you have it, there's the fortress. Now, let's see if our skeptic can find a crack.
Section 3, Finding the Structural Cracks. An impressive fortress, I'll admit it. That's a strong case. But it's my job as the skeptic to find the weaknesses. And the market's violent reaction tells us there's a storm coming that could knock that whole fortress right down.
And here it is, the first major crack in the armor. This quote, and we pulled this from market analysis on earnings day. It cuts right to the heart of the problem. All those fantastic record-setting numbers were, in the market's view, overshadowed by $500 million in adverse fuel cost impacts. Just think about that for a second. A $500 million headwind. This isn't some minor detail buried in the footnotes of the report. This is a massive, uncontrolled expense that is directly eating up the profits the analyst was just celebrating. It's the primary reason the market totally ignored all the good news.
Now look, facing a headwind is one thing, but sailing directly into a hurricane with zero protection, that's just strategic malpractice. This slide right here reveals a staggering vulnerability. Carnival's fuel hedging strategy is 0%. They are completely exposed to the whims of the global oil market. Now, a hedge is basically an insurance policy, right? You lock in a future price for your fuel so that if prices spike, you're protected. Their main competitor, Royal Caribbean, has about 60% of their fuel needs hedged. This means while Royal Caribbean has a strong shield, Carnival is taking every single dollar of rising oil costs straight to the chin. It's an incredibly high-stakes gamble, and the market is punishing them for it.
And this isn't some theoretical problem. This is the direct financial damage right here. With West Texas Intermediate crude oil pushing $100 a barrel, Carnival was forced to take an axe to its own full-year forecast. They cut their adjusted EBITDA guidance, that's earnings before interest, taxes, depreciation, and amortization, a key measure of cash flow, by almost $500 million. And their adjusted EPS forecast, the number investors watch most closely, was slashed from $2.48 all the way down to $2.21. That is cash that was promised to the bottom line that is now literally being burned up in their fuel tanks. And with all the ongoing geopolitical instability, there's really no end in sight to this problem.
All right, Section 4, PROPEL. Management has a new growth plan they say will navigate these challenges. But the question remains, is it a solid structure that's really designed for the storm, or is it just a house of cards waiting to fall?
So the fuel issue is a real headwind, okay, I'll concede that. But management's answer to this is their new long-term strategy, and they're calling it PROPEL. It's their vision, and it's built on 4 main pillars. One is commercial excellence. That basically means just continuing to drive the record demand and pricing that we've already seen. 2, investing in fleet and destinations. So smartly allocating capital to things that improve the customer experience and generate higher returns. 3, leveraging scale in tech, using their massive size and new technology to become more efficient and control those costs. And finally, the big payoff for investors, outsized shareholder distributions. It's a clear, logical blueprint.
And they have put some very specific and very ambitious targets on this plan for 2029. They're not just offering vague promises here. No, they are targeting a return on invested capital of over 16%, which is a key metric of capital efficiency. They're promising over 50% growth in adjusted EPS from their 2025 numbers. They're planning to return a massive $14 billion to shareholders through buybacks and dividends. And they believe they can do all this while bringing their debt leverage down to a much more manageable 2.75 times EBITDA. This is management showing supreme confidence in their long-term earnings power.
And that's exactly where my house of cards argument comes in. Look, confidence is cheap. Execution is everything. And this is the question the market is asking. Can these incredibly ambitious targets actually be achieved? They are making these grand promises while at the same time getting battered by fuel costs, while being completely exposed to geopolitical energy shocks, and while carrying a mountain of debt on their back. The execution risk here is immense. It's easy to put $14 billion shareholder return on a PowerPoint slide. It's another thing entirely to actually generate the free cash flow to pay for it, especially after paying for fuel and servicing all that debt.
And that brings me to Section 5, the mountain of debt. My final point is the most critical one, because unlike fuel costs, this isn't some temporary headwind. No, this is the permanent weight of an anchor on Carnival's balance sheet, and it absolutely cannot be ignored.
Just look at that number, $25.3 billion. Let that sink in for a moment. That is the total debt sitting on Carnival's books right now. This is the toxic legacy of the pandemic. To survive the global shutdown, they had to borrow billions upon billions just to keep the lights on. Now sure, the passengers and the revenue are back, but that debt remains. Every single dollar of profit they generate, every dollar of cash that comes in the door, has to first answer to this enormous liability. This isn't just an accounting entry, folks. It is a first lien claim on the company's entire future.
And this isn't some problem they can just kick down the road for later. This table shows they have billions of dollars in principal payments coming due every single year for the foreseeable future. This creates immense and constant pressure on their cash flow. They have to generate enough cash to run the business, pay for all that expensive fuel, invest in the fleet like their PROPEL plan demands, and pay back these maturing loans. It's an incredibly tight rope they have to walk. It leaves absolutely zero room for error. One slip-up, one economic downturn, and this debt schedule could trigger a genuine crisis.
And hey, you don't have to take my word for it. The official referees of financial risk, the credit rating agencies, have already rendered their verdict. S&P's rating for Carnival's debt remains below investment grade. You know what Wall Street calls that? A junk rating. It is a formal declaration that the agency sees a significant and elevated risk of default. And this has real, tangible consequences. It makes all of their borrowing more expensive, which in turn makes refinancing that mountain of debt even harder. It's a flashing red light for any risk-averse investor out there.
All right, Section 6, the verdict. So let's bring it all together. You have a company with a powerful operational engine, but it's being weighed down by these massive financial anchors. So what is it? Is Carnival an opportunity, or is it a trap?
So here it is, the final weigh-in. The iron case, the bull argument, is built on that foundation of undeniable operational momentum. You've got the record revenue and bookings, which prove demand is completely off the charts. You have that incredible swing to profitability, demonstrating efficiency and leverage. And yeah, management has laid out an ambitious growth plan with PROPEL and a commitment to shareholder returns. But the hidden cracks, the bear case, are just as compelling. That 0% fuel hedge is a critical self-inflicted vulnerability. That $500 million fuel headwind is actively destroying shareholder value as we speak. The massive $25.3 billion debt load is a constant drain on everything, and that junk credit rating is the market's official stamp of high risk.
And so that leaves us with this final crucial question. Is Carnival's powerful operational engine truly strong enough to carry the immense weight of its financial and strategic risks? The bulls are betting that this record demand can generate enough cash to power through the debt and the fuel costs. The bears believe that those risks are simply too heavy and that any external shock could completely capsize the entire recovery. Here at Iron Financial, we don't give you the answers. We give you the framework to forge a stronger decision. The market has placed its bet. The question is, what will yours be?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.